clearly it was reestablished that ESG is not at odds with commercial returns, but it is mandatory and probably a competitive advantage to commercial returns. We'll quickly move towards a very, very different panel. CAT 3 investments. Is it a promising decade ahead? Does it continue to have the bright future? As per Securities Exchange Board of India, data relating to activities of AIFs till 31st December 2021, total assets of AIFs have gone up to rupees 6.09 trillion in Q3 FY22 from 5.35 trillion in Q2 FY22. That's quite a jump. From the year-on-year perspective, it is 38% growth from total AIF assets in Q3 FY21, which stood at 4.41 trillion. In the last 10 years of AIF regulations in India, while the growth of Category 2 funds comprising of private equity, real estate, stressed assets, and other private market strategies is unprecedented, Category 3 funds, that is hedge funds, started well but have recently slowed down, and many diverse product strategies are yet to grow in the market. The panel shares perspectives on one hand of the experiences of the last decade, biggest hurdles till date, need for simplifying regulatory overhang, and on the other, growing interest of HNIs and family offices in diversifying portfolios into different hedging strategies that offer a better alpha. For this panel, I invite Shehzad Medon, Head, Alternative Assets, Nippon Life India AIF Management Limited, as the moderator. Welcome, Shehzad. We also have as panelists Andrew Holland, CEO Public Markets Alternate Strategies of Vendus PE, Akshay Manusukhni, Managing Partner, Malabar Investments, Dr. Pritesh Majmudar, Head, Legal and Compliance, DSP Group, and Nalin Moniz, CIO, Alternative Equity, Edelweiss Asset Management Limited. Thank you all for joining the panel and look forward to hearing some interesting perspectives. Over to you, Shehzad. Thank you.
Thanks, Alka. I think Shehzad had a presentation that they're trying to load at the moment. Let's give it a few seconds.
president@ITCA.in. Yeah, just one sec. Yeah.
Yes.
Yeah. Jimit, can you please change the first
President
name
at
and
the
the
rate
last name of president at the rate IVCA.in of the bank? Thank you.
IVCA.in.
You're on stage, Prasad.
Thanks. Am I visible? So great. Then I can't see myself. But all the same, great. Thank you so much for for having me, for having all of us in this session. And uh, what I would so we've got a wonderful panel out here, and we are out here to talk about the growth of the Cat 3 industry over the last few years. It's actually, can I request Vivek if you could just pull up my presentation, right? Uh, Very briefly, a very brief introduction to the industry. It's been 10 years, roughly 10 years, May 2012 since the industry started, and since then the industry has grown rapidly and in terms of funds raised. So pretty the growth in Category 3, which is on slide 3, which is really what we are
Shehzad, your connection is not coming
very
through.
interesting analysis we've done, and we've just tried to compare the growth of the three industries put out there, which is the growth of the mutual fund industry in the first 10 years. If you could see that slide, actually PMS and the Aif industry, all in the investment management sector. I think these are at different points in time, so comparisons are not precise and are not intended to be. But just wish to just leave with you the following: that what we are saying out here is that as an AIF industry, we've grown far faster in our first 2 years of growth than than let us say the other investment management licenses which come under which the investment license. And it's not just a base effect, because if you look at the growth over the last uh, you know 5 years, 3 years, 1 year, two, the industry continues to grow well. So there's obviously a lot which the industry is doing well. Coming to category 3, which is on slide 3, which is really which is what we're discussing out here, is that the industry has grown rapidly, and in terms of funds under, let's say, management, it's about 56,000 crores, which is a fair bit of money. There are 160-ish AIFs, two-thirds of which are in the long only category, and one-third are long short funds. And we contribute about 20% of the overall funds raised. So the growth in category 3 has been faster than that of the overall industry. And that's something which is encouraging. And we have a very vast diversity of managers, some of who are on the panel. So with that little bit of a background, I'd just love to go over to our panel. And we've got a panel which comprises great industry leaders who've been around for a long time. So I'll start with Andrew. Andrew, I hope I'm audible. And my first question to you is: given that you are a veteran in the investment management industry, played various roles, etc., and the group, or the Aventis group which you represent, really does category 2, category 3 funds, how would you describe the growth of category 3? And in category 3, you guys both do long only as well as call it the hedge funds which you look after. So just wanted your overall perspective on how the industry has grown, uh, how things have played out over this last decade. And specifically, if you could also talk about a little bit about taxation, because our industry has been, there's obviously a big impact of taxation. So over to you, Andrew. Happy to hear your view.
No, as you've Shazad, as you've shown in your excellent charts, it's been a fantastic journey and growth of the overall industry, and I think for Aventis as a whole, in our cut to kind of strategies, which is more towards kind of pre-IPO investments. It's been a great platform to get investors into some of these fast growing unlisted companies, which we're seeing more and more unicorns day by day. So I mean, that's been a platform which 4 or 5 years ago really wasn't being used for the growth and the prosperity of investors. So that's the great news. On the Cat 3 side of it, I mean, again, the growth has been spectacular. I think you showed 50,000 crores there. I think it's kind of plateaued though a bit, and I think the reason behind that has obviously been the taxation part of it, and we're always trying to get that pass-through taxation past the government and the finance secretary, but it just doesn't seem to be kind of happening at the moment, which is a bit sad because when I look at Gift City and the expectations there, we all know that when you look to launch over offshore, a lot of the endowments and pension funds and funds of funds will look for a kind of track record in your home country before allocating money. So if we could help grow the industry in Cat 3 by removing this tax, I think it have a great impact as well for Gift City and the growth of Gift City going forward. So we're still hopeful, we're still trying, but the good news is this: is that if we were speaking maybe 4 or 5 years ago, there would probably been myself, Nalin, Aifs, and DSP, and that would be it. But now there's so many more funds there educating investors, and investors are looking for more and more funds like we manage, to kind of enhance their returns whilst also reducing risk. So the journey's been so far so good, and I think it could be accelerated if we can just do something about the tax.
Sure. So thanks for that, Andrew. And I am aware that your organization, guys like Nalin too, have done a lot of, and IVCA, of course, and IVCA has been at the forefront of this, doing a lot of work on the taxation part. Hopefully, sooner than later, there will be some good news for all of us. But okay. Thanks, Andrew. Akshay, you guys manage long-only funds, and you have a wonderful track record at doing bottom-up stock picking, quite differentiated stock picking out there. I just want to ask you this question, because in front of the entire investment management industry, you have the following sort of issue. You have mutual funds which are getting increasingly regimented, and we all know the regulations around them. Mutual funds have to get bucketed into, I'm talking about now on the equity side, bucketed into certain categories, and mutual funds are looking closer than ever to each other, right? There's very little deviation you can do, and you have to work within a fairly circumscribed framework. For the mutual fund audience, I think that's a wonderful thing, right? But then there's also PMS, and there's also AIF. And where do you think the sort, and of course, sorry, I forgot to add that we also have ETFs, and ETFs is also nibbling away in a sense at the active managed assets, especially on the large cap. So wanted to get your perspective as managers, as guys who do, bottom-up stock picking, run a lot of such strategies, which is just based on delivering alpha, right, and quite differentiated from the index. How do you see the Cat 3 AIF industry, and how do you see the the overall future of this playing out? Right?
Sure. No, thanks, Shazad. Really appreciate the question. So when in 2010, when we started, before the current regulations were in place, we realized that putting a trust structure would be the wisest commingled vehicle across the partners at Malabar, and we preceded the current regulations. And then SEBI, I give a lot of credit to them for being very open minded and being open to having discussions, basically asked the first APAC to come in place. And when I introduced myself, and Mr. Narayan Murthy continues to head that group, I said, what Warren Buffett does, old school, kind of concentrated portfolios, heavy diligence, and really buy businesses that can compound for many years. That very thing is not included in the definitions of the regulations, right? We've basically had regulations being defined as complex derivatives, which there's a place for that within the industry, but that was the starting point. And then over the years, many trips to Delhi, I thank everybody on the line here to have helped finally CBDT came out with a circular saying that if you've been defining your kind of your gains in a certain manner, the IT officer cannot come after you and say, hey, we're gonna catch you for something. So that at least that clarity came out, where for groups such as ours that don't do any derivatives, are long-term oriented, it really helped us, where we were structuring ourselves as private equity funds to be ultra conservative on the taxation side. And today there's a lot more acceptance in the industry to be more open-ended. And so I think that's kind of where the industry is going. Obviously, if pass-through comes through for Cat 3 funds, I think we would welcome it. So I think that's kind of the backdrop. Then, in terms of where things are today, there are numerous kind of smaller groups. When you kind of think about the difference between a mutual fund and an AIF, an AIF is a smaller corpus. It gives an impetus to kind of smaller groups to start off. And I myself am surprised by the number of smaller long-only groups that have flourished, and we very much welcome it. And ultimately, if we converse with the long-short kind of funds and provide a combined solution to SEBI, I think that's the way to go. I think in terms of long-term alpha generation, there's a lot of opportunity. You just take a big step back. If you look at America, 25 trillion GDP, 51 trillion stock market. China at a 14 trillion GDP, maybe 8-9 trillion stock market. And India is running in that 3 zip code, 3 trillion GDP, 3 trillion stock market. We have another 20-30 years of growth, strong growth ahead of us, because the markets the last 20 years have shown to be highly correlated with the GDP growth, in that 12-13% zip code. Last thing I'll say is just in terms of differentiating as managers. Different managers do different things, but ultimately it boils down to consistently generating alpha over the market cycles. And I think that's the part that I want to drive home, is with the benefit of hindsight, you can see market cycles, and for the managers who performed over the market cycles, it is useful to have kind of a combined evaluation across other players. However, combining all kinds of category 3 funds may not provide the accurate picture to clients. So I think sophisticated clients do need to be aware of how they're comparing funds to. But overall, I think we've come a long way, and appreciate SEBI and IBC's efforts to getting us to the point at the moment.
Sure. Great. Akshay, thanks for that. Nalin, what I would address to you is something similar to what I addressed to Andrew, that your organization too manages, well, category 2, category 3. You particularly look after the category 3 funds. Again, you have long only, and you have the funds you manage, which are the hedge funds, etc. And you have also, you've been in the industry from the very, very beginning. So wanted your perspective on the growth, taxation too, because that's important, taxation regulations. And if you could share any insights which you might have on new areas of growth, because primarily, this is essentially either call it a long short and a long only market. Primarily, these are the two categories. Is there anything else which we're missing? Is there anything else which could come up? Any interesting areas? So wish to get your perspective on all of this.
Thank you, Shazad, for having me on. And as you rightly started by saying that the last decade has been super exciting for the AIF industry and category 3 in particular. I agree with Andrew that not having pass-through taxation on Cat 3 has been a little bit of a downer. But when I look at the data, I see that the growth numbers are still staggering in spite of that headwind. And I'm excited about that. Let me give you some numbers. So in 2018 Union Budget, a surcharge on derivatives was introduced. And at that point in time, the Cat 3 AIF industry was about 15,000 crores. In about 3.5 years, it has grown from 15,000 to about 58,000, almost 4x in 3.5 years. And Since that announcement, Shazad, we have had over 100 new license holders who have come forward and joined the industry. So the growth is broad based and secular in nature. And I think that the funds, whether long only or long short, serve a very important purpose in a client's asset allocation and hence are able to overcome this headwind of even taxation. In terms of areas of innovation and growth that I'm seeing, uh, on the long only side, as Akshay said, there are so many star fund managers and boutiques that are coming forward with new investment styles and investment approaches. But the one thing that's new is that I'm starting to see many fund managers have maybe 5 to 10% of their long only portfolios in pre IPO positions. And that is something that is unique. On the long short side, I think there is a clear demarcation between lower risk funds that compete with debt offerings and higher risk funds that compete with equity offerings. I'm starting to see some managers also dabble with commodities and multi asset investing as a new area of innovation. And lastly, Shazad, we have managers like Northern Arc or Whitespace that have also started to launch Cat 3 debt funds.
True.
It's very, very nascent, but I think after the Franklin Templeton episode and ILNFS and all the defaults that have happened on the MF side, this is an area to watch in the future. So
Sure.
that's innovation in a nutshell. A lot of exciting times ahead.
Sure. Thanks, Nalin. And all of you guys on this panel have been at the forefront of a lot of that innovation. So that's great. Yeah. We spoke about the regulatory backdrop, and a lot of the panelists rightly mentioned that we've got a very good regulatory framework which we have set up in place. And if you look at it, to set up regulations which cover so many distinct and different types of asset classes, right, is something which is completely unique. Because if you look at the MF or on the PMS side too, that's fairly monolithic, right? That's very, very monolithic. It's very simple. It's this category and this is it. But in the AIF, there are so many different asset classes, so many different sorts of managers, boutiques. It's also disparate. So they've put in a great framework, and without that great framework from the regulatory perspective, we wouldn't have got here. Right, very, very clear. You wouldn't have got to this size of industry. So just wanted, Pritesh, as somebody who's been deeply involved again with this industry for a long, long time, wanted your perspective of how things have played out, the good, maybe the not so good, and of course, different, I would say, things maybe which need improvement, but just wanted your perspective. If you could trace the history, it might be very useful to our audience.
Yeah. So thanks, Shahzad. And on regulatory front, I could say that the AIF regulations were notified in 2012, and thereafter SEBI has made several amendments and have issued several circulars and notifications strengthening the regulatory regime. But I would touch upon the key changes which has really brought about transparency, enhanced the governance, especially in 2020 and 2021. For example, in 2020, for the first time, SEBI came out with a circular streamlining the disclosure standards in AIF space and introduction of performance benchmarking and standardization of the PPM. That's a private placement memorandum. These changes are likely to bring about higher disclosures and transparency in the AIF space, especially existing and potential investors. And standardization of PPM will definitely eliminate any variance from any manner of disclosure which are seen at various AIFs. So there was nothing uniformity as far as the disclosures were concerned. So that was one. Next, definitely the stewardship policy, where SEBI has put up a mandatory code for AIFs for all categories, and where they want intervention, monitoring, and engagement with the listed entities, the equities where equity investments have been there. Apart from that, also disclosure of the proxy voting qua the investee company. And rightfully, the code will improve investor protection as well as foster good corporate governance. Next, the entire regime of accredited investor, where SEBI approved the framework, and this framework can be viewed as a step forward for more relaxed regulatory environment, especially for the sophisticated investors, which will definitely bring India at par with other global financial hubs. So, from investor perspective, it will help portfolio diversification through access to customized investor products and more investment due to low entry barriers like minimum investments. From issuer perspective, it will reduce compliance burden and provide flexibility in designing investment products. And the entire market ecosystem, if you say, this is a very light touch regulatory framework which will help develop security market with more products and more participation. Next, for category 3, we can say that flexibility to invest in a mix of both investee entities and other AIFs. That would definitely help category 3 to invest. Earlier it was only category 1 and 2, but now it will lead to more investment opportunities for cat 3. Next, definitely the welcome move of enhancement of overall limits for overseas investment from 750 million to 1500 million, which will help again asset diversification in terms of geographies, and enable Indian AIFs to generate strong returns for their investors. And last but not least is the code of conduct, which SEBI has put in place for AIFs, trustees, key persons, and the investment manager, which actually lays down the guiding principles on their accountability towards various stakeholders, including the investor, investee companies, and the regulator itself. So all these, if you see in a nutshell, definitely will improve transparency, governance, and strengthen the regulatory environment and the growth of the AIF industry.
Sure, great. Thanks. Thank you, Pradesh, for that. Andrew, wanted your perspective on how do you see in AIFs, how do you see, let's say, the long-short AIFs, typically a lot of which you guys manage and are at the forefront of that, fit into an investor's portfolio? So when you look at an entire investor's portfolio, where does it fit into? What does it address? And also your take on, we've over the last few years, of course, had a nice one-way bull market. Most of us are very pleased with that, especially the long-only guys. In more choppy market conditions, which is what we might be facing in the not too distant future, right? How do you think let's say the role of long short funds, etc., and how will they play out?
Let me tackle that in two ways, Shazad. It's a very interesting kind of set of questions. But if I think about the growth going forward for the hedge fund industry, and I'll call it hedge fund industry.
Sure.
If I look in globally, hedge funds represent something like 5% of total assets under management. But more significantly, they represent 40% of total revenues. Now, what we're going to see going forward, and I'm sure, Dalin in particular, I'm sure within his own organization is being sought after because, with the likes of passive funds coming in, there's a kind of a move not to the bottom in terms of fees, but obviously we're seeing more and more mutual funds, moving into category 3. So this is great news. Don't get me wrong. I'm not saying it's not, but it's only going to help grow the industry. And what we've seen over time, Shazad, is that investors are looking for differentiated products. If I go back for many, many years, we had either debt, low risk, or equity, higher risk. And there was kind of nothing in between that risk curve. And that's what, the likes of, all of us are trying to achieve for the investor. So if you go back, before this kind of problem with Russia and Ukraine, most investors you're speaking to saying, can you please show me a product? We want to be long of this market, but when we put money in, we need some protection, for any kind of, volatility that we might be seeing going forward. So increasingly, you're seeing a lot more different products. I saw one mutual fund launch a product, long-only product with some black swan type hedges the other day. So, I think more and more of these products are going to be developed by everybody to help investors, walk through this kind of, whilst in the long term, we can say the market grows at 12 to 15%, there's times when, more recently, when volatility really hurts you. And if you can help protect the investor throughout this, then I think consistently, then they'll come to your products, and I think that's what the way the industry I think will evolve over time, is adding more products to help the investor kind of walk through a market which will have its times when it's not just a bull market, and it's more trying in that respect.
Sure. Thanks, Andrew. Thank you for that. Nalin, hedge funds are, well, long only are relatively more people are more familiar. Let's put it with long only. But in the hedge fund category, it's still for a lot of people, while the industry has grown very well, it's still relatively new, right? So how would you suggest that an investor or any of our distribution partners would evaluate and judge different, let's call it hedge funds, and say that, this is really good or not so good, or what would be the key framework one should look at when assessing hedge funds?
Right, Shazad. And I just want to answer that question by recounting the journey of the last 10 years. So when Andrew, myself, DSP, and others started the very first long short funds, people were allocating money largely based on a promise or on an idea, and largely on the back of faith of an institution or an individual manager. All of us now collectively have about 7 to 8 years of live client track record each, and there are a lot more metrics available. Today, there are aggregators like PMS Bazaar, PMS AIF World, and others that publish our returns. Our wealth managers are used to seeing a certain attribution, and they've also gotten comfortable with the styles in which each manager manages a portfolio. So today, the industry is still small enough and a little more intimate where a potential investor or a potential advisor can still meet with uh, Andrew or myself or Gaurav Pant at DSP or anybody else and understand what is it that we do. And if it fits their needs, they go ahead with an investment. But I think what is important, Shazad, is that going forward, as the industry scales in terms of number of managers and number of funds, uh, you will have formal categorization that comes in from CRISIL and from SEBI. Uh, and in the future, fund selection may mirror what is happening in the mutual fund industry, where people like Value Research or Morningstar just have star rankings, and then
Sure.
people select based on that. So that's the evolution of where we were, where we are today, and where we will be at some point in time.
Sure. Very, very useful. Thank you, Nalin. Akshay, um, today when one looks at sort of bottom-up stock picking, there are two vehicles which typically come to mind. So one is the PMS vehicle, and the other is the AIF Category 3 vehicle. These are broadly the two vehicles which come to mind. Typically, MFs are, are closer to beta vehicles, as in you're trying to outperform the index by a bit. How do you compare the two? Because I'm sure you guys have carefully evaluated the pros and cons of both options and come to the conclusion that the AIF Cat 3 is probably the most appropriate vehicle for you to address your investors' needs. So you just want to compare the different vehicles to us. Feel free to compare any other vehicle in case of missed it too, and be used
Sure.
for your sort of strategies.
Sure. So, going right at the start, we realized that basically the PMS was not something that would work for us because simplicity in our daily lives is important, and just having one portfolio is something that stands out. To the point that Nalin raised earlier on a pre-IPO investment, it becomes challenging allocating a pre-IPO investment across clients, and so having it in a commingled vehicle is important. I think on the there are pros and cons, to each, and I'll just highlight some of them. So one is on the pre-IPO side. I think the other is with regards to taxation. The PMS wins on that one, in that if a client has certain carry forward losses and they want to set it off in the future, the AIF Cat 3 today does not allow for that. The PMS does, because the Cat 3 is effectively paying taxes and then giving tax paid monies back to to clients. I think the other piece is kind of the asset controls, the AUM controls, and that point would be more on the mutual fund side. If you see historically the last many years, sometimes the top performing mutual funds have not stayed the top performing mutual funds because the assets have rushed to those names. And recently we've seen some mutual funds putting certain kind of brakes on AUM inflows at the wrong time. But that's been the Phil Fisher story, right? One of the best track records of value investing globally, and on average investors lost money with him. Why? Because they came in and came out at the wrong points in time. So I think that control, and having a unified control for the AIF, at least for us, has worked out, because otherwise clients coming in and coming out at different points in time sometimes may dilute the returns. From clients, we have heard, unfortunately, that sometimes the PMS returns are misrepresented, because that one client that comes in for March, April 2020, it's absolutely accurately recorded that, look, these are the returns for the client, but it's for that client at that point in time. The aggregate track record is different than what that specific point in time is. So that is something that I think, from again to Nalin's point, in terms of having an aggregate kind of rating system, that could be the future. And then I think the skin in the game part is the final piece. The skin in the game on the PMS side is difficult to track, because you're investing clients' capital in their name, in their demat account, and who knows, kind of from a trust perspective, if a manager has performed over many cycles, clearly investors should trust them and should continue to stay invested. But for a new manager coming out, it's difficult to show the skin in the game on the PMS side, because reporting your own personal statements to the client may not be adequate, versus on the AIF side, having a commingled vehicle where the manager is invested, as well as a sponsor. There's certain minimum percentages that creates a tremendous amount of comfort, that if clients are trusting you with their hard-earned money, and a lot of your own capital is getting the exact same returns as clients' capital, that makes for a healthy evolution going forward. So I think there's room for all players to grow. We're happy that the AIF is where it is. And then the last one I'll say, up for the mutual funds, is the lack of taxation within their own trading, which results in a much higher turnover compared to others that actually do need to pay taxes at point of sale. So that is an advantage that the mutual funds have, but the high level of turnover sometimes does impact the returns as well. So yeah, those are kind of the pros and cons.
Sure. Great. Thank you, Akshay. Last question. I think that's all we might have time for, but let me address it to Pritesh. And Pritesh, let's just say you were given Aladdin's magic lamp, and you have the ability to, now include whatever regulations you choose to, right? And those regulations, of course, would be you take care of the interest of everybody, which is, of course, the regulator and consequently the investors, the managers, all our partners. Everybody is happy. What might you include?
Wow, very good question, and the wish list would be really big. But yeah, I mean, certain areas which I can think is like allowing banks and insurance companies to invest in category 3 AIF, then allowing investment in foreign securities. Today, we can invest only in overseas venture capital undertakings. But if you see on the mutual fund side, a mutual fund can invest in overseas fund, ETFs, as well as foreign equities also. So why not AIF can category 3 in specific be allowed to invest in foreign equities? I mean, on the mutual fund side, we have industry-wide limit, and thereafter we have fund house level limit. Why can't that be replicated to start with? A certain portion of the AUM can definitely chase foreign securities. Next could be allowing AIF category to invest across categories of SEBI registered mutual funds. Today, they can only park the uninvested portion in liquid mutual funds. So why not in other categories of mutual funds too? Next, there could be, if I can think about, is increasing the leverage, which is today twice. We cannot leverage more than twice. If that can be increased, that would really help create wealth creation and returns for the investors. And relaxing certain onerous compliance requirement, especially on the Cat 3 side. Recently, filing of PPM through merchant bankers has been introduced unnecessarily. That is increasing compliance burdens and it's against ease of doing business theme. So at least for category 3, which is investing in listed space, if that could be relaxed. And because on one hand we have a template prescribed by SEBI as to what should be the content of the PPM, and there is a regulatory mandate to even annually get the PPM audited and also ensure that the terms of the PPM have been adhered to by the AIF. So all those regulatory regime is there. Then why the need of unnecessary filing of the PPM through a merchant bankers? So these are certain things. If regulatory revisit we can happen, then definitely it will help foster the growth of AIF.
Great. I guess I think just run out of time, or just on time, have 1 minute more. So I guess I'd just thank all the participants for a wonderful job. You guys have been splendid, and I'm sure the audience really enjoyed the session. I think take this opportunity, of course, to thank the regulator for the wonderful set of regulation, all industry participants for getting us here, the good job everybody on this panel has done, and IVCA for putting this together. IVCA, I think you guys are outstanding. You've done a wonderful job. Rajat, thank you. And to the entire team who's all put it together. So I think we should wind up with that, right? Then it's 4:40. And thank you for your participation. And
thank you, sir.
keep up the great work, everybody. Bye-bye.
Thank you, guys. Thank you.